Hi, welcome to our group presentation focused on the analysis of the impact that tariffs played during the US-China trade war. Our group is comprised of Haley Armstrong, Feng Nguyen, Barry Weaver, and myself, Brian Rogers. Quick disclaimer here, throughout our analysis, we will take a nonpartisan stance on these issues and only present the data as it is. So as for the origins of the US-China trade war, it can be seen here that the trade between the two countries really started to take off in the 80s as a result of Chinese economic reform in the 70s that promoted increased exportation and was further grown due to China's entrance into the World Trade Organization. Both the Bush and Obama administrations used tariffs primarily on Chinese textiles in an effort to punish China for their tendencies to export goods at dumping prices. Now, dumping prices are a pricing policy in which exports are priced so low that they essentially damage the respective importing country's economy. However, this war primarily took place during the Trump administration, which ran on a platform that denounced several of China's alleged unfair trading practices, IP theft, as well as purposeful undervaluation of their currency. This administration aimed to use tariffs as a tool to really expand domestic production and pressure China to improve their trading policies. China denied these claims of IP theft and proclaimed that trade wars were really more harmful than helpful, and said that the US was engaging in protectionism. Here's a chart on manufacturing jobs over the last few decades against a few important pieces of legislation during these times. The red zones correspond to Republican administrations, while the blue to Democratic. And you can see here that jobs were really on a decline from the 80s up until the 2000s. And then we see an increase up until COVID hit. And with that, I'll hand things over to Haley.
Thanks, Bryden. I'll be walking through the timeline of events beginning in 2018. The U.S. imposed tariffs on select goods from all countries and was considering tariffs of $50 billion on goods from China. In response, China placed tariffs on 128 products from the U.S. The U.S. then listed potential goods to impose tariffs upon. China placed additional tariffs that included soybeans, which are a top agricultural export of the U.S. to China. The U.S. then announced potential tariffs on 100 billion of Chinese imports. China canceled all soybean orders from the U.S. Both countries entered into trade discussions where China agreed to reduce the trade deficit by increasing purchases of U.S. goods. In July, the U.S. imposed a 25% tariff on 34 billion of exports, and China retaliated with a similar amount. Both also placed additional tariffs in September and began negotiations again in December. These negotiations were not successful, and in May of 2019, the U.S. increased existing tariffs on 200 billion of goods from 10% to 25%. China responded with tariffs of 60 billion and reduced their U.S. Treasury holdings by 25%. In response, the U.S. announced 10% tariffs on 300 billion. China's central bank permitted the yuan to fall by 2% over 3 days, and the U.S. declared China a currency manipulator. China responded by ordering no further purchases of U.S. agricultural products. Both placed tariffs again in September before entering negotiations. In January of 2020, they entered into the Phase 1 trade deal. China agreed to purchase an additional 200 billion of U.S. goods and services over the next 2-year period. The U.S. agreed to decrease their existing tariffs and to delay scheduled tariffs. Due to the pandemic, both countries granted various tariff exemptions throughout the year, and China was a top trading partner again. At the end of 2020, China had only imported approximately 100 billion of goods, which falls short of the agreement. Thus far in 2021, the U.S. tariffs remain in place, and there are plans to review the Phase 1 trade deal. And now I'll pass it off to Barry to discuss the impact of tariffs.
Thanks, Haley. I'm going to be talking about the impact of the tariffs. Before we jump into the results, I want to quickly touch on the data sources and methods that we used. For data, we primarily pulled from 2 sources, the U.S. Census Bureau for foreign trade data and the U.S. Bureau of Labor Statistics for manufacturing jobs data. It's important to note that for the foreign trade data, we were specifically looking at only the imports and exports of goods and not services. For methods, we plotted all of our visualizations in R, and all regression models are based on the ordinary least squares method. We first wanted to take a look at where we were in the U.S. when Trump came into office and began his tariffs. So this plot shows the U.S. trade in goods with China and U.S. manufacturing jobs in the period of 1985 to 2017. Trade is plotted on the y-axis and time is on the x-axis. You can see the exports as the blue bars, the imports as the orange bars, and the black line representing the trade balance. So as you can see, that trade balance was growing increasingly negative as time went on, therefore representing a growth of the trade deficit with China. Similarly, you can see the manufacturing jobs plotted out at a secondary y-axis in the red line. And again, you see a downward trend showing job shrinkage in the manufacturing industry in the US. So we then took a look at the years after the tariff began against China, and you do see a shrinkage of that trade deficit from a balance of $375 billion in 2017 to $311 billion in 2020. So it does appear that the tariffs had the impact of shrinking the trade deficit with China. Jobs are a little bit more difficult to interpret because COVID also occurred during the same time period. So it does appear that 300,000 jobs were lost from 2017 to 2020, but we'll circle back and take a closer look at the jobs market later. So we next wanted to say, okay, if the trade deficit with China is shrinking, does that mean more money is staying in the US and being invested in manufacturing jobs here? So here we have the balance of trade, however, with all of our trade partners from 1987 to 2017. And again, you see that negative trend in the trade balance showing an increasingly large trade deficit. However, unlike the trade deficit with China, when you take a look at the 3 years after the tariffs began, you see the trade deficit continues to grow, almost by 100 billion between 2017 and 2020. So while it does appear that the tariffs had the impact of shrinking the trade deficit with China, they did not ultimately cause consumers to bring their money back into the US. So we wanted to see where that money might be going. So we took a look at some of our other trade partners, for example, Vietnam, and looked at the trade balance from 1992 to 2020. Again, you see a growing trade deficit year over year. However, it's interesting to note that in 2018, when the tariffs began, you see the rate of increase of this trade deficit drastically increase. So you see that slope get much more steeper, and the trade deficit nearly doubles between 2017 and 2020. So what appears to be happening is that when the tariffs were implemented, US consumers are just looking for the next cheapest option. So increasing imports from Vietnam, Mexico, other trade partners, rather than keeping that money here in the US. So we now wanted to take a deeper look at the manufacturing jobs. So here we have the jobs plotted on the y-axis, I'm on the x-axis, and we have both Obama's second term in office and Trump's term in office plotted. So you can see in blue Obama's term, as well as the regression model showing that around 9,500 jobs were added per month during Obama's term in office. Similarly, you see the Trump trend of jobs in orange showing around 13,300 jobs added per month during his time in office. It's important to note that we excluded the post-COVID months to create the regression model. So although you see those plotted, that massive drop in the job market, those are not included to generate the regression model. So it does appear that the rate of job growth during the Trump presidency was larger than Obama's. However, visually, you can already tell that we see really high job growth during the first 1.5 to 2 years of his presidency, and then stagnation and almost decreasing of the number of the manufacturing jobs during his third and fourth term, even before COVID hit. So we wanted to create two different models, one before the tariffs started and one after. So we chose July 6th, 2018 as the date to kind of split between these two models, as that was the first date that the US announced Chinese imports would be targeted for tariffs. What we see here is that during that time period before the tariffs, we saw job growth of around 19,400 jobs per month. So really great job growth, almost double or more than double what we saw during the Obama presidency. However, when you look after the tariffs started, you see much smaller job growth, only 970 jobs per month. And again, this is excluding the COVID month. So the takeaway here is that the tariffs did not ultimately have a positive impact on creating manufacturing jobs in the US. I'll now pass it over to Feng to analyze these results a bit further.
Thanks, Barry. Hi, everyone. This is Feng Wen, and I will talk us through our group's key takeaways. So I'm sure you're all itching to know who won. Well, if our group had to pick a winner, it'd be Vietnam. The second big winner is China. In the short term, exports to the US from Vietnam rose 35%, or 17.5 billion in 2019. And that's huge. In the long term, Vietnam also wins an FDI from both the US and China, as we and the Chinese look to nearby countries that can help sidestep potential trade wars or retaliation in the near future. We think China comes in second place because they promised to buy hundreds of billions in US exports, but have so far fallen short of their promises with impunity. Further, one of our stipulations in the agreement made under Trump was for the Chinese to beef up their IP protection, which the US saw as a big win. But really, China's been needing to beef that up anyway, so in a few of the articles we read, it seems like that was more a win-win than an us win. Now, let's talk unintended side effects. In our research, we found 2 issues that we'd like to highlight in our discussion because we felt that these were important issues that oftentimes got downplayed in the media. The first unintended side effect is how this trade war affected all of Wall Street. The Federal Reserve Bank of New York did a study in 2019 where they found that U.S. companies lost at least $1.7 trillion in the price of their stock as a result of the tariffs. Why? Because 46% of the 3,000 firms they studied, which encompassed virtually all of U.S. market capitalization, were exposed to China through importing or selling through subsidiaries or some other way. So even if they didn't deal exclusively in steel or agriculture, like the Gap or Apple, nearly half of our U.S. companies suffered financially because they rely in China in some way or another. The second big unintended consequence is us losing out on listings to the Hong Kong Stock Exchange because Chinese tech firms no longer see the U.S. as a safe place to IPO. Companies that originally listed on our exchange, such as Alibaba, are looking to Hong Kong for their next listing. In the long term, this is a fresh set of blows to U.S. hegemony in financial markets, and this is very much a win for China. Now, let's shift gears. There are so many other unintended consequences, but to keep this presentation concise, those were the 2 that really captured our attention in our research. So if we didn't win, did we at least accomplish our goals? Well, our first goal was to decrease the trade deficit, and to this, we definitely didn't accomplish it. As you can see with this chart, we're still importing way more than we're exporting, and that will likely just be the case. Although you may have seen headlines that our trade gap with China fell 3.2%, that's not much to celebrate because our trade deficit with other countries just increased. Mexico, for example, rose from $1.6 billion in trade deficit to $11.9 billion by January 2021. The second stated goal for this trade war was to bring back manufacturing jobs. Growth in U.S. manufacturing jobs flatlined, which is code for no net increase in jobs. If anything, this trade war has cost U.S. jobs to the tune of 245,000, according to the U.S.-China Business Council. So in conclusion, this trade war has been covered by many news outlets, trade organizations, and academics all across the world. And we kept finding in our research that the general consensus is that the U.S. definitely did not win this trade war. And as you can see from our group's analysis of available data, we agree with the consensus. And with that, we conclude our presentation. We open the floor to your questions. Thank you.